Hello, Assalamu alaikum students. This is your teacher Azka, and today we are going to solve paper 2 accounting O levels IGCSE. And the code for O levels is 7707 and for IGCSE it is 0452. So we are going to start this paper. This is latest paper May June 2024. So let's start. Okay. Okay, so we have question number 5, and in question number 5 if you can see that. Okay. So Ajay is a retailer and he has provided the following information. At 1st April 2023, we have inventory, trade receivable, cash at bank and trade payables. For the year ended 31st March 2024, so this is the year start information, this is year end information. So we have the information for the year end, which is the revenue. We have two types of revenue, credit sales and cash sales, purchases, expenses, and we also have the inventory, trade receivable, cash at bank, and trade payables at the end of the year. So let's see that what is the requirement for this question. So the first requirement is that we have to find out the gross margin and it should be correct to two decimal places. So first of all, if we want to find out the gross margin, so first of all, we have to find out the cost of sales. So let's find out the cost of sales. So what is the formula for the cost of sales? Opening inventory plus purchases minus closing inventory. So that would be our cost of sales. So let's see what is the opening inventory. So opening inventory is equal to 5200. As you can see, this is the year start inventory. So that's why inventory opening inventory is 5200. And our purchases. Okay. So these are the purchases which is happened during the year, which is 51300. And the closing inventory is 6500 because this is a year end inventory. So this is the closing inventory 6500. So just put the values accordingly. So 5200 plus 51300. Okay, so we have 50,000, which is our cost of sales. Okay. Um, so now let's see, because we have two types of sales, if you know, we have two types of revenue. First one is a credit sales and second one is the cash sales. So we know at the year end we have to add both sales, whether this is credit sale, whether this is cash sale. So 86,400 plus 10,600. So we have the total sales, and which is basically 97,000. So that would be our total sales. So we have the cost of sales. So just deduct the cost of sales from the total sales. So we have the GP. Because for find out the gross margin, what we have to do is we have to divide, we have to multiply the gross profit with 100 and divided it by the sales. So if you deduct the cost of sales from the revenue, so we will be having a gross profit. So gross profit is equal to 47,000 divided by 97,000 was our sales. So our answer would be 48.45%. So this is basically our gross margin. So now we are going to find out the profit margin. So what is the profit margin? So profit margin, first of all, we have to find out the profit. We know that 47,000 was our gross profit. we have to deduct expenses from it. So at the end, we will be getting a profit. So let's see that what are the expenses. Okay, so as you can see that we have the expenses for this year, which is 23750. So let's deduct the expenses from the gross profit. So we will have the profit. We know that what is the formula we basically following to find out the profit is GP minus expenses is equal to profit. So first of all, find out the profit. So profit is basically 23250, 23,250 is our profit. Multiply by 100 and divided by sales, because we are going to find out the profit margin. So it means that we basically find out that what is the profit percentage into in total sales. So our total sales is 97,000. So out of 97,000 dollar sales, our profit margin is 23%, 23.997% of total sale, which is 97,000. So this is our answer. After that, we are going to find out the rate of inventory turnover in times. Okay. So whenever we have to find out the inventory turnover in time, so we would not multiply it by the 365, because whenever the examiner asks that you have to find out the rate of inventory turnover in days, so we will be multiply with the whole equation with the, 365, divide by 365. But we don't need to find out the inventory turnover in days, so that's why we will be using the simple formula for it. So inventory turnover is equal to your cost of sale. So let's find out what was the cost of sales. Okay. So for rate of inventory turnover, we have a formula. We have to divide the cost of sales by the average inventory. So find out the average inventory. What we have to do is we have to add opening inventory plus closing inventory divided by 2. So we have the closing inventory and opening inventory is 5,200 and closing inventory is 6,500 divided by 2. And whatever the information, whatever the answer you will get, just divide 50,000, which is cost of sale, by the average inventory. So we have 8.55 times if you calculate it on your calculator. So you will get this answer, 8.55 times. So the next question is that trade receivable turnover days. So first of all, let's see trade receivable turnover. Okay. So we have the trade receivable, which is 9550. Okay. And our current sales is 86,400. So we know to find out the trade receivable turnover, we apply this formula. We divide the trade receivable by the current sales, okay, and multiply it with the 365. So we just put the values and we will get the answer, which is 41 days. The next question is that liquid asset test ratio to 2 decimal places. So we know that in liquid ratio, or you can say the asset test ratio, we don't need to add the current, we don't need to add the closing inventory in our assets. We'll only see the bank balance and the cash and the trade receivable. So now let's see. We know what are the trade receivable. Trade receivable 9550, which is already written here, and our cash at bank is $1,200. We don't have any other current asset in this list. So 9550 plus 1,200. And what are the liabilities? So we have only the current liability, which is trade payable. So divided by the current liability. So we will be having our asset test ratio, which is 1.79 into 1. Okay. So the next question is that Ajay has been trading for 3 years and he has established a good reputation. He has never changed his selling price. His gross margin for the year ended 31st March 2024 is higher than the previous year. So if he didn't change his selling price, so it means that it is very obvious that why the GP is increasing. Why? Because the cost of sales are decreasing. So the simple reason is that. So suggest one reason why Ajay's gross margin has increased. So one reason that why Ajay's gross margin has increased is that the cost of goods sold has decreased. So this is a very simple reason. Second question, state one reason why Ajay's customer might be interested in his financial statement. So we need to state the reason. So their customers, Ajay's customer basically concerned for the financial statement. Why? Because they want to assess his business stability and the credit worthiness, that how much credit they will be getting from Ajay. Ajay is concerned about the levels of his inventory and trade receivable. He is considering reducing his selling price. So the C part is that I advise Ajay whether or not he should reduce his selling price. Justify your answer by providing pros and cons of reducing his selling price. Okay. Uh, so basically, first of all, I have written the advantages of it. So a lower selling price can lead to higher demand and increase sales value, helping to clear excess capacity. So this is the first advantage. The second advantage is that reducing selling price can help Ajay sell his inventory more quickly, reducing storage cost and risk of inventory obsolescence. So this is the second advantage. So we know that in the 5 mark question, we have to write two pros, two cons, and at the end we have to give recommendation. So in against, lowering the selling price will reduce Ajay's profit margins, potentially impacting his business profitability. So this is the first disadvantage. And reducing selling price may be perceived as a devaluation of Ajay's product, potentially harming his brand image. So this is kind of, you can say that qualitative factors. So at the end, I suggest that Ajay should not reduce selling price because it may harm Ajay's business long-term profit margins. So that is my reason that why Ajay should not decrease his selling price. Okay. Although Ajay's gross margin has increased, his profit margin has fallen for each of the last 2 years. Sales revenue is Ajay's only income. So, straight true reasons why Ajay should be concerned about his falling profit margin. So, first one, the reason is that reducing profitability. That's why he should concern. And then the second thing is decrease the financial resilience. So, yes, so we have done with the question number 5. So, let's move to question number 4. So, we have the question number 4, that Tadeen and Yadid are lawyers who have been in partnership for many years. The partners provided a following trial balance at 30 April 2024. So we have this trial balance, okay, and what we have to do is, this is the additional information, okay, and this is the information for the appropriation account. Um, and we have to prepare the income statement. So in income statement, if you see, like, this is the service business, this is not the manufacturing business. So if this is a manufacturing business, so we have to make the trading account. It means the cost of sales here. But because these basically both partners are lawyers, so it means that they are giving services. So that's why they will not be having any kind of cost of sales. So first of all, we have to write the revenue. So what is the revenue? Revenue is 236,350. We already have it in here. And after that, now let's find out the expenses. So in expenses, we have the first one, it is salary. But if you see, there are some additional information. And for the salary, in the note 2, this is written that at 30 April 2024, 1800 for salaries was due but unpaid. So that was unpaid, which is $1,800 salary. So it means that we have to add it because we didn't pay it, but it is related to this year's expense. So that's why we have to add this. So 79,800 plus 1,800. So this is 81,600. And after that, we have the rates and insurance. So now let's see. Okay, so we have the rate and insurance, which is 17,320. 17,320. But if you see that there is basically adjustment here, and the adjustment is that rates and insurance included an amount of 1920 for the year 1st March 2024 to 28th Feb 2025. Okay, so as you can see that the total rates and insurance expense is basically 17,320. But if you see this adjustment, that rates and insurance include an amount of 1920. So it means that 17,320 included 1920. Basically, this amount is included in the 17,320. But if you see that this amount is basically paid on for the year 1st March 2024 to 28 Feb 2025. So this is basically your prepaid expense. So we know that whenever there is a prepaid expense, so we should only include the expense which is related to this year's income statement and this year's expense. It should not be written in the current year's income statement, because if this is the advance payment from your side. So if you see that it is paid on 1st March, so it means that it has been used on 1st March and April, because our year is ending on 30 April. So 2 months basically has been used. So it means that we have to include only 2 months payment into this year's income statement. And if you see that further, because this payment is will be starting from 1st March and it will be expiring at 28th February 2025. So if you just count the months, so 1, 2, 3, May, June, July, August, September, October, November, December, January, February. So this is 10 months. So 10 months are left. So it means that we have to deduct 10 months payment from 1920, and we have to deduct all together from the total expense. So let's see. So 17,320 is the total expense minus 1920 multiplied 10 over 12. So 10 basically is representing the months which is remaining. It means that this is the payment we are going to deduct. This is the payment for the 10 months and divided by the 12, because in 1 year there are 12 months. So that's why. So 10 divided by 12 multiplied by 1920. So we have 1600. So it means 1600 is not related to this year's expense. So let's deduct 1600 from the 17,320. So we have 15,720 in our answer. Okay. And after that, we have the advertising expense and office expense. So these are very simple, low interest. So we just need to write it as it is, because there is no adjustment for these things. Advertisement, office expenses, interest on loan from Tadeen. So this is 1200. So when we know that whenever we are taking loan from any partner for the business use, so of course we will be adding this into the expense of the business. Okay, and after that, we have the depreciation. So we have given the depreciation, which is the depreciation on fitting and equipment is to be charged at 15% per annum using that straight line method. So now let's see that fittings and fixtures. So we have already the provision, which is 31,500, and we have the cost. So let's deduct the provision from the cost, and whatever the answer is, just apply 15% on that. So 17,000 multiplied by 15%. How basically I get 70,000 minus 31,500. So we have 17,000 in answer, and just multiply the depreciation rate on the accumulated depreciation. Okay, so we have done with this part. And after that, we have the irrecoverable receivable. It means the irrecoverable debt. So now let's see how much irrecoverable debt we have. So we have the receivables, which is 13,000. We have, 1 second. We have receivable here. Okay. So in third adjustment, if you see that irrecoverable receivables at $3,670 are to be written off. Okay. So these are the bad debts, 670. This is added into expense. So altogether, the total expenses are 13,000, 1,33,000, 32,570. So it is deducted from the sales revenue, which is 2,36,350. So we have the profit for the year, which is this. Okay, so now let's move forward. So in the next question, we have to prepare the appropriation account. So first of all, write the profit for the year, and we have to add interest on drawings. So these are the drawings by Tadeen and Yadid, and the interest on drawing were 5%. So altogether, this is 4040, and add 4040 with the profit of the year. So this is 107820, and less interest on capital. Um, so Tadeen's capital was, so these are the Tadeen capital account, which is 125,000 and 85,000, and multiply it with the 3%. So you will be having the interest on capital. And there is one more thing, which is salary to Yadid, which is $10,000. So we have to deduct it. And at the end, residual profit and losses are to be shared is equal to 60% to the Deen and 40% to Yadid. This is very simple entries. So if you just multiply 3% by the capital accounts of Tadeen and Yadid, so we have 3750 and 2550. Altogether, this is 6,300. And the salary paid to Yadid, which is $10,000. So altogether, we have 16,300. And if we deduct 16,300 from this figure, so you will be having the residual profit, which is 9520. Now we have the positive figure, so it means that this is a profit for the both of partners. So 9520 for Tadeen, it's 60% would be the profit share for Tadeen, and the 40% of 91520 is the profit for the Yadid. So 91520 multiplied by 60%, 54912. This is the profit for Tadeen, and 36608 is for the Yadid. The second question, the C part is that state one reason why the partners might consider reducing their drawings. So the simple reason is that because they want to avoid the debit balance on their current account, because we know that whenever there is a debit balance on the current account, so it means that it is decreasing our current account. So that's why there is a simple reason that why we are doing that. If we are reducing our drawing, so it means that we can increase our current account. That's why. Second part is that which accounting principle reflects the partner's intention to continue trading indefinitely. Yes. So we know that this is whenever we have positive intention for run our business in the long run. So this is the concept which called going concern. Okay, so the next question is the partners employee one lawyer and office staff. The lawyer Lakia is paid $25,000 but has decided to leave. Tadeen and Gadid have found a replacement lawyer, Ryan. He has worked as a lawyer for 15 years and is well known in the local area. However, Ryan wants to be a partner in the business rather than employee, and would expect 40% of the residual profit of the partnership each year. So we have to advise Tadeen and Gadid whether or not should offer Ryan a business partnership. Justify your answer by providing points for and against offering Ryan a partnership. So I have written the points for four. So Ryan has 15 years of experience as a lawyer, which would be valuable asset to a partnership. This is the first advantage. And the second advantage is that Ryan is well known in the local area, which could attract new clients and enhance the partnership reputation. So this is the qualitative information. So, and in against profit sharing, 40% of residual profit could significantly reduce Sadeen and Yadid's share of profit. This is the first disadvantage. And the second one, that loss of control by offering Rhyme a partnership, Dadeen and Yadid would be giving up some control over the business and decision making principle. So at the end, I think we should go with the partnership, because of course if they have to share the profit, but the profit would also increase because Ryan has a positive image. Okay, so I think we have done with this question. Yeah, so we have done with the question number 4 also. So now let's see the question number 3. Okay, Akil prepared his trial balance at 29 Feb 2024. The total of the debit side was 83,640 and the total of the credit side was 84,025 dollars. Akil later discovered the following errors. The total of the sales journal for January 2024 is 3,416, sorry, had been carried to the sales return account. Okay, so we know that the sales journal should be carried, and but what we did is that we carried the sales return account. So now the entry is very simple. We will be debiting the sales return account and crediting the sale account. And the second entry is, as you can see that we already have did this thing here. So sales return is debit and sales account is credit. 3416. Second entry is a direct debit for insurance $115 had been credited to both bank account and the insurance account. Okay. So basically we credit the insurance account, we should debit the insurance account. Like this is the insurance account. So we should debit this by 115, but we carried this mistakenly. And the bank account, we should debit it. Sorry, we should carry it. We should carry it by 115. But what we did, we debit the bank account, I guess. Having carried about, yes, we direct debit of insurance 115 had been carried to the both. Okay, so we carried it, but we should debit it, the bank account. So now if we just rectify this error, it means that if we rectify the bank account, if we are writing 115 here, and in insurance account if you write it here, so it will be cancelled out with each other. That's why we have to make the entry by double amount. So that's why what we have to do is just debit the insurance account, and because there is nothing on the credit side, because we already carried the bank, so that's why. So there is nothing on the credit side, so you're there where there is nothing, there will be suspense account. So 115 multiplied by 2 is equal to 230, and there is a suspense account will be carried by 230. Okay, so in the third one, discount allowed $47 had been credited to the bank account for discount received. Okay, so this is again very simple. Discount allowed 47 had been credited to the account discount received. So we have we have to debit the discount received account because we have to reduce it, and we have to debit the discount allowed also by $47. So it means that both accounts would be debited by $47, and on the credit side where there is nothing, there would be suspense, which is 94. 47 plus 47 plus 47 is equal to 94. Okay, and error 4. Okay, so basically they have the requirement was just to correct the errors 1 to 3 only. Okay, so we have already done that. Okay. So we have this requirement part A, state which business document shows when the direct debit of insurance was paid. Simple, this is a bank statement because we will be getting our bank statement from the bank, and we will see that in the bank statement our insurance is basically direct debited. In question number 2, which of the error listed in 1 to 5 above is the error of principle? Okay, so basically the error of principle, because we know that these are not the errors of, because these are the errors which is affecting the trial balance. So the errors which will affect the trial balance, these errors doesn't have any names. These errors don't have any names. Okay, so it means that 1, 2, 3 would not be any kind of error, because these are the errors which will affect the trial balance. We know there are two types of errors. First one is the errors which would not affect the trial balance. So the errors which will not affect the trial balance, those errors will be having a name. But the errors which do affect the trial balance, those errors would not have any name. So that's why 1, 2, 3 would not be would not be having any name, so that's why we are neglecting it. So now let's check out the 4 and 5. So your fifth error is that purchase journal for Fab had been overcast by $90. So basically, this is the original entry error, because in original entry we always write the amount differently. So that's why this is the original entry. And in the note 4, a payment in error 4, a payment for office equipment, which is $52, had been debited to the stationery account. So we know that office equipment is the asset account, and the stationery account is the expense account. So it means that we made the asset account the expense account, and we made the expense account the asset account. So we know that this is kind of the principal error, where the account side is the same, but the account type is wrong. So these are the principal error. Okay, so we have done with this already. We already have done this question. So now let's move forward. State why a balance may remain on the suspense account after errors 1 to 5 have been corrected. So a balance may remain on the suspense account balance because all the errors have not been yet been founded, and that is the reason that why it is rare. So we have to prepare the suspense account. So this is very simple. If you see that your insurance account is debiting and your suspense account is crediting, so it means that in the insurance account, in the suspense account, you will be writing it here: suspense account credit, insurance account debit. And in third error, your received discount allowed was debit and the suspense account was credit. That's why here a key account is credit. It means the suspense account is credit, and received discount allowed is debiting. Okay. So the error number 5 is the purchase general for Fab had been overcast by $90. Okay, so if you have had overcast this by $90, okay, so that was not an error, I guess. Yes, that was not an error. It means that this is not the errors which do not affect the trial balance. It is affected by trial balance. This error doesn't have any name. This is not the original entry error. Okay, so purchase general for Fab had been overcast by $90. Okay, so what we have to do is now, because we overcast purchase journal, so it means that we know that whenever the purchases are increasing, so it would be debit. So if this is overcast, so we have to credit the purchase journal and we debit the suspense account. So that's why it is written on the debit side here. Suspense debit, purchases credit. Okay, so if you see like 230 plus 47 plus 47 151, so this is 475. So credit side is heavier, so it means that a trial balance difference would be on the debit side. So suspense debit and trial balance would be carried by 385. So 475 minus 90, so this is 385. Sorry, my mistake. So basically total trial balance difference has been written at the start. Yes. The examiner has said that a total of debit side, which is 83,640, and the total of the credit side, which is 84,025. So it means that credit side is heavier and the debit side is lower. The debit side was short and the credit side is heavier. So credit side is heavier and the debit side is shorter. So what does it mean? It means that the difference is on the debit side. So it means that our suspense account would be debit by, because our short side is on the debit side, so that's why our suspense account would be on the debit side. Okay, so we have 47 minus 90 minus 385, so we have the 151, and that would be our balance media suspense account. Okay, so in D part, if you see that calculate a key's profit after item 1 to 5 have been corrected. Okay, so the original draft profit was 17,420. If you can see, that is already written here. So if you see the error 4 and error 5. So error 4 is that a payment for office equipment 52 had been debited to a stationary account. So it means that we have increased the expense. So if we increase the expense mistakenly, so now we have to decrease the expense. So when the expense decrease, so it means that your profit would be increased by $52. And the error number 5 is that purchase journal for fab had been overcast by $90. So if the purchase journal has been had been overcast, so it means that you had increased your cost of sales. And when the cost of sales increase, so it means whenever the cost of sales increase, so it means that your GP would decrease and hence your profit is also decrease. But if you rectify it, so it means that you will be increasing your profit by $90. So that's why I have written it on here. This is a plus sign that in 17,420, 52 and 90 is added back. So let's see the error 2 and error 3. Okay, so a direct debit of insurance 115 had been carried to the both the bank account and the insurance account. So we carried the insurance account. So it means that we decrease the expense. So it means that now we have to increase the expense. So when we increase the expense, so your profit would decrease by 115, and discount allowed 47 had been carried to the account of discount received. So it means that we mistakenly increase the discount received account, but now we have to decrease. When we will be decreasing the discount received account and we will be increasing the discount allowed account. So when we increase the discount allowed account, so we know that discount allowed is basically the expense for us. That's why we will be deducting this from the profit. So that's why, but with the double amount, 94. So 230 plus 94, this is 324. So we will be deducting 324 altogether from this. So we have the draft profit after correction, which is 17,238. Okay, so we have done with this question. Okay, so we have this question number 2, that Toya owns a factory which makes dolls houses. Her financial year is end on 31st January to 31st January. At 31st January 2024, her ledger accounts include the following balances. Okay, so we have these balances, and what we have to prepare, we have to prepare the manufacturing account at the for the year end 31st January 2024. Okay, so first of all, we have to find out the cost of material consumed. So how can we find it out? We have to write the opening inventory of raw material plus purchase of raw material minus the closing inventory of the raw material. So if you see that here we have these three things. So inventory at first fab, so this is the year start inventory and this is the year end. So raw material is 12,400, and we have the purchase of raw material which is 143,000, and we have the closing inventory of the raw material which is 11,205. So it means that our cost of raw material is equal to 144,195. So we know that we have to add all the direct costs if we want to find out the prime cost. So if you see, like, we have the labor cost here. Uh, these are the wages for the factory operators. These are the wages for the factory operators. So we know that factory operators, the workers basically who are doing the, who are participating into production directly. So that's why this is also the part of the prime cost. That's why we have to add this. So these are the direct wages, which is 51,000. So 51,000 plus 1,44,195. So we have the prime cost, which is 1,95,195. So after that, we have to write the factory overheads. So in the factory overheads, first of all, we have the wages of factory supervisors, which is 19,000. We have the factory electricity, which is 16,000. We have the rates and insurance, but we do have an adjustment here. So let's see that rates and insurance. So what are the adjustments we have? So these are the rates and insurance, and we have the adjustment here. The rate and insurance are to be proportion, a portion 2/3 to the factory and 1/3 to the office. So basically, we are preparing the manufacturing account. It means the account for the factory. So that's why we will be multiplying the total rates and insurance with the 2/3, because 2/3 part of the rates and insurance is the cost for the factory, expenses for the factory. So that's why we have to multiply it with 2/3. So we have 10,800 is the answer. And after that, we have the journal factory expenses. If you see that we have a journal factory expenses, which is 6155. Okay. And we do have an adjustment here that at 31st January 2024, journal expenses of 234.5 were unpaid. So that was unpaid, but it's related to 2024 expenses. So that's why we have to add it to 35. This is the uh, accrued expenses. So 6155 plus 235, so we have 6390. After that, we have to find out a depreciation for factory machinery. So this is the cost of the factory machinery. This is a provision of depreciation, and we are using the RMM on that. So we know that in the RMM, first of all, we had to deduct the provision for depreciation from the cost, and we will be applying 25% of the rate of depreciation on the net book value. So we have this depreciation. Okay. And we have to add the opening work in progress and less the closing work in progress. And after that, we will be having the cost of production, which is very simple like this. There is nothing tough in that. Okay, so we have done with this. Now we have to prepare the income statement for with the trading section. Okay, so we basically only have to prepare a trading section, not the proper income statement. So first of all, let's see the revenue. So the revenue is 390,100 for the business, and we have the opening inventory of finished good, which is 14825, and we have the closing inventory of finished goods, which is 13480. So revenue is 3,90,100, and cost of sales opening inventory plus cost of production, which we just calculated from the previous for factory, which is 2,63,548. And deduct the closing inventory because we don't have any purchases for the finished goods. So that's why I just deduct the closing inventory from that. And we have the cost of sales, which is this, and deduct the cost of sales from the revenue. So we have a gross profit, which is 1,25,207. So this is very simple again. Okay. And next question is a factory produced 6,936 dolls houses during the year ended 31st January 2024. Calculate the manufacturing cost of each doll house. Round up your answer to the nearest. Okay. So basically, we are producing 6,936 dolls, and we have the cost of production. If you see that we already have found it, this is the cost of production. It means that this is the cost of production for producing the dolls. So this is the total cost of production, and if we made 6,936 number of dolls, so it means that our per doll cost will be 38. Okay, we have the last question that Idir, a competitor of Toya's, has decided to cease trading. He has offered to sell his inventory of finished goods to Toya at a discounted price in return for immediate payment in cash. The total price of these items is $9,600. Toya has 1,415 cash at bank. Advise Toya whether or not she should buy either's inventory. Justify your answer by providing 2 points and and 2 points for against buying the inventory. So for the positive points we have that she should be able to make a profit on this discounted inventory. Of course, she will be having a discounted inventory, so it means that she has a chance to increase the profit. And second thing is that as the inventory is already completed, she may be able to turn the inventory into cash fairly and quickly. And this is the negative points, that as she doesn't have sufficient cash to pay for inventory, because we can see, so she may incur overdraft interest, and it may cost money to store the additional inventory. So these are the disadvantages. So I think we she should not go with this option. Okay, now we have question number one. So Lottie is a trader. Her financial year end is on 30 April, and she keeps her petty cash book using the Impress system. Impress amount is $150. Total of the payment analysis column in her petty cash book for April 24 as are as follows. So we have cleaning expense, stationery, and salary expenses. So during to April 24, Lottie received a refund of damaged stationery, which is $15, and this amount was received into petty cash book. Okay, so calculate the amount required to restore the petty cash impressed on first May. Okay, so these are the expenses 21, 47, and 44. So it means that and deduct the minus 15. Why? Because this $15 we received as a refund. So that's why it means that $97 in total we have to refill, or you can say the restore as impressed amount. The petty cash book is one of the books of prime entry. So state one another prime books of prime entry. So there are different prime books: return inverse journals, return outward journal, CS journal, purchase journal, cash book is also a prime book. So we just need to write the name of the prime and prime book. So cash book and CS journal can be the answer. Okay. So the second question is the two advantages of using the books of prime entry. Okay. So first of all, they remove detail from the ledgers. The first thing is that because all the details were written in the prime book, so there is no details should write in the ledgers. So this is the first advantage. They are useful for preparing control accounts. Yes, whenever we know that whenever we are preparing the control accounts, we will be using the prime books. So this is the advantage of using the prime books. Okay, so I have written the three advantages, but you should only write two advantages here. On 30 April 24, Lottie sold a motor vehicle for $6,000 on credit to Buy Limited. She had purchased the vehicle on 1st May 2021 for $12,000. Letty charges depreciation on vehicle at 25% per annum using the reducing balance method. No depreciation is charged in the year of disposal. So C part is that calculate the accumulated depreciation for on the vehicle at 30 April 2024. So we have purchased this on 2021. Okay, and no deficit in the charge of the year of disposal. So if we purchase this 2021, so at that time we have to find out. So from 2021 to 2022, our first year would complete. So for the first year, we will be applying 25% of the cost, but not on the net book value, because at the initial year we don't have any kind of net book value. So 12,000 multiplied 25%, we have 3,000 depreciation, and depreciation for the year end, which is 2023, because we sold out this asset on 2024, so we should not provide a depreciation for 2024, because the policy is saying that no depreciation is charged in the year of disposal. So 2024 is a year of disposal, so we will not charge depreciation in 2024, but we will charge depreciation for 2023. So in 2023, we will be deducting the depreciation from the cost, because in the second year we will be applying this 25% on the net book value. So 12,000 minus 3,000 is equal to 9,000. So this is the net book value. So multiply 25%. So we have 2250 as the depreciation. So we have to find out the accumulated depreciation, not the net book value. So the first year we charge 3,000, and the second year we charge depreciation, which is 2250. So altogether we have the total depreciation, which is 5250. In the second requirement, we have to prepare a disposal of motor vehicle account. Okay. So disposal of the motor vehicle account. Uh, okay. So first of all, when we purchase, when we sold the asset, so what entry we should make? We have to uh, decrease the asset account. So it means that your motor vehicle would be carried and your disposal account would be debit. So that's why 12,000 is coming here. And when we sold out this asset, so we know that our provision for depreciation account is always credit. But when we sold out one asset, so we will be decreasing its provision for depreciation. We will be decreasing its depreciation, so we'll be debiting the provision account. So our provision account would be debit by 5250 and disposal account would be carried. And we sold the asset to Y Limited for $6,000. So it means that Y, and this is happened on carrot. So it means that your Y limited would be a debit and your disposal would be carrot. 16,000. 6,000. Okay. So its provision was 5250. Its cost was 12,000. So 12,000 minus 5250. So it means that its net book value is 6750, but it is sold for 6,000. So it means that there is a loss. It should be sold for 6750, but it's sold for 6,000. So it means that there is a loss of 750. So whenever there is a loss, so your income statement would be debit and disposal account would be carried. So that's why 750 is written here. So disposal carried and income statement would be debit. Okay, so we have the next part. So Loti sells three different types of goods. Her inventory at 30 April 24 is as follows. So we have this inventory. A type, B type, C type, we have the number of units, we have purchase price per unit, we have carriage inverse per unit, and we have the net realizable value per unit. So calculate the value of Lotus inventory at 30 April 24. So for the A type, we have 60 number of units. So we have the total number of units, which is $60, and sorry, 60 number of units. We have the purchase price per unit is $14, and NRV is $20. Okay, and carriage inverse per unit is $1. So if you see that its NRV is higher and its purchase price, its cost is lower. So that's why we will be value the product type A on its cost. So if you see that in the cost, its carriage inverse is also add into the cost, because in we know that in the cost of any raw material, we have to add the carriage inverse into it. So 14 plus 1, this would be giving you $15. So it is still lower than the NRV. So we will be valuing the item A on $15. So 15 multiplied by 60, which is the number of units. So we have the $900 of valuation. For item B, we have the $17 of purchase price. We have zero carriage inwards. We have NRV, which is 924. So it's lower. Uh, uh, what is the lower between the NRV and the purchase price? So the cost is lower. So we will be valuing the item B on its cost. So 85 multiplied by 17. So we have 1445. For item C, so if you see that its purchase price is 21 and its carriage inverse is 2. So 21 plus 2. So this is giving us 21, 23. So this is the cost for the item C is higher, but its net realizable value is lower. So that's why we will be using the NRV. So 30 multiplied by NRV, which is 22. So 22 multiplied by 30, we have 660 valuation of item C. So altogether, we have total valuation, which is 3005. Okay. Okay, so prepare the insurance account for the year and 30 April 2024. Bring down the balance at 1st May 2024. So Lottie insurance account, we have this. Okay, so now let's see the information first. So Lottie pays 360 per annum for insurance on 1st May 2023. The insurance was $60 was prepaid. So for the insurance account, if you know that we will be using the mnemonic which is PAP, P-A-A-P, PAP. So whenever the balance BD is in prepaid, so we will be written it, we will be write it here. Whenever the balance BD is accrued, so we will be writing it here. And whenever the balance CD would be prepaid, we will be write it here. And whenever the balance CD is accrued, so we'll be writing it here. So we have the insurance of $60 was prepaid. So this is the year start balance. It is prepaid. So that's why we'll be writing it here. Balance BD which is $60 at 1st May. On 1st August, Lottie paid $60 by bank transfer on the year for the year 1st July 2023 to 30 June 2024. So she basically paid $360. So it means that 360 would be, because insurance account would be debit and bank account would be credit. So bank account would be carried by 360. So 60 plus 360. Okay, so balance BD was $60, and we already given $360 in the bank account from the bank account. So 60 plus 360 is equal to 420. Okay, so as you can see that it is written here that $360 is the per annum for insurance. I mean, that is the year, 1 year payment for the insurance account. So it means that $360 would be transferred in the income statement. So 420 minus 360, so it means that we have $60 as a prepayment. So that's why this would be coming under the credit side. Balance CD, if this is prepaid, so this would be coming under the credit side. So if this is balance CD at the year, at the month end, so it will be transferring it. We will be sorry, at the not the month end, at the year end. So we have the $60 at the year end, which is $60. So we'll be transferring it into the next year, which is 2024 May 1st. So we have the balance BD, which is $60 at the start of the year. So okay, yeah. So we have done with all question. Um, yes, so we have done with all question. Okay. So